Welcome to the Fog of Investing. Few topics are more rife with myths and misconceptions than investing and how to grow your wealth for your future. Today we're going to cut through and clarify those very important topics. What you're about to witness is the compilation of the best financial minds in the industry, including Nobel Prize winners. And you may even recognize your own financial coach in today's movie. So sit back, relax, and enjoy the movie.
How do I invest? So many images. What do they mean? All these commercials.
Shouldn't you be doing this?
It's really straightforward. Listen, I gotta go, Bob. We'll talk to you later.
Okay, Mr. Mover and Shaker, that's enough trading for today.
Does experience like this matter? It does, if you care about results.
Gain from our perspective.
The 5-second guarantee. Bad idea for fine dining. Good idea for online trading.
We juggle some things in the portfolio. I think we could make that happen a little sooner than we thought.
Sweet.
Tym że nie ma atramentu.
What?
And not just on television. Ever try to read an article without seeing a financial advertisement? Wow, sailboats, mountains, and a starry night. Maybe that'll help me invest. All of these famous, trustworthy faces. The financial firms must be reputable to be able to license these famous icons to be the image of their company or even sing about their services. Golf clubs, big sport for finance. Could that help me be a successful investor? Who helps me to build capital to save money? This says the most important financial tool of all is trust. Who do I trust? This says superior quality to high net worth individuals. Well, am I high net worth? I've put 2 of my children through college, but I don't own any of the exotic perks of life. Does the wealthy echelon know something about investing I don't? Doesn't my hard-earned lifetime savings and retirement deserve the same respect and treatment as that of the rich or famous? So many animals as corporate symbols. Of course, bulls and bears. And is that an elk or a deer? Penguins, kangaroos, thoroughbreds, dogs, elephants, and giraffes, whales, polar bears, and dolphins.
Lions and tigers and bears.
Oh my, it's all so confusing. Over 10,000 stocks and nearly 30,000 mutual funds. An indefatigable onslaught of impressions, bids, and offers, all designed to lure the investor, you, to their financial services. When I do pick a television station, it's confusing as to exactly what I'm supposed to watch. Do I watch the talking head? Do I watch billboards of numbers on the side? Or do I read the numbers and news zipping by below? It's video pollution of the screen. Whatever happened to one screen and one picture? It used to be so simple. Although there are times when producers know the advantage of one face, full screen, full of attractive information.
We have anchors on CNBC. One of them is called The Money Honey.
Burton Malkiel is professor of economics, Princeton University Bentheim Center for Finance, and the author of the classic financial book, A Random Walk Down Wall Street. You will hear more from Professor Malkiel later in the program. How does one know if the often fickle, ever-altering aspects connected with investment might affect an individual's own portfolio? Does Medicare or Medicaid have anything to do with it? How about war? The cost of a barrel of oil? What if Social Security bankrupts? Do my investments take a hit? How about the Fed? Mortgage rates, a gallon of gas, a Sandy-type superstorm, or a disastrous oil spill? The economy. By the way, who measures the economy? How can I tell if it's soft or strong, and how does it affect investment? Defense spending, Congress, the strength of the dollar, crime costs, school bonds or school levies, rebuilding levies, buy your lunch or bring your lunch, whole wheat or sugar. Wait, that's the diet industry. The haze can easily take an innocent investor way off track. Back to investing. Should I trade derivatives and futures? How do I consider federal tax, port security, homeland security, the deficit, gross national product, international trade, cyber theft? There's a classic military expression, the fog of war. Former Secretary of Defense Robert McNamara explained it as, war is so complex, it's beyond the human mind to comprehend all of the variables. Other military experts use the term fog to describe war's ambiguities, the realm of uncertainty. 3/4 of the factors on which action is based are wrapped in a fog of greater or lesser uncertainty. The financial equivalent in the 21st century is the fog of investing. How do you navigate the incomprehensible variables, predicaments, and the realm of uncertainty surrounding investment decisions? How do you find your way to the simple goal of building a retirement portfolio to live the golden years with the money you've worked for? How exactly do you escape this dense shroud of utter confusion, navigating the fog of investing? Back to the primary question, how do I invest my money? Perhaps the first method of cutting through the fog is identifying what to burn off and ignore. The crescendo of commercials and marketing campaigns loudly shriek to turn your money over to market professionals at huge commercial wirehouses who depend on 3 primary schemes after they secure your money: market timing, stock picking, past performance or track record investing. These 3 schemes are what author Mark Manson, who is also the CEO of a financial firm managing billions of dollars for clients, calls 3 flagrant myths that cost investors terrible tolls.
The professionals themselves are in a fog. They don't know. You know, they don't know that stock picking, market timing, and track record investing are speculating and gambling.
Stock picking, market timing, and track record investing are not prudent methods of investing because they are not investing at all. In fact, they all represent speculating and gambling with your money. Now, if you want to gamble, millions of people do that, and it's legal in many pockets of the world. However, if you're looking to build wealth, for example, live off your 401k in your retirement, then you do want to invest via the vast body of academic research which promotes being allocated and diversified throughout the world markets. You do not want to gamble or speculate with stock picking, market timing, or track record investing.
First, let's examine the perils of market timing. A market timer, also known as a forecaster, says get in because the market's going up, or get out because the market is going down. Well, how do you know what the markets of the nation or the world are going to do? The only market timer forecaster who would be interviewed is Mr. Harry Dent. In 2004, I interviewed Mr. Dent. He had just released the book, The Next Great Bubble Boom. On page 6, he predicted the Dow Jones could reach as high as 35,000 to 40,000 by late 2008 or in 2009. In this 2004 interview, I asked how he could see the future so clearly.
Well, you know, the difference is we do use a science called demographics. We know when the average family earns the most money, spends the most money, is the most productive, when they borrow, when they save, even when they eat potato chips or buy motorcycles in midlife crises. So we look at the economy different. We look at it more like a life insurance actuary. They don't see the future as unpredictable. They know the average person's going to die at age 77.6.
I told Mr. Dent we had been interviewing leading academics, including the brilliant 1990 Nobel laureate in economics, and he would never agree with Mr. Dent. Dr. Harry Markowitz received the Nobel for his groundbreaking research on modern portfolio theory. Dr. Markowitz says prediction is a guess, not a science.
If anybody tells you they know with any kind of precision which way the market will move, run, do not walk in the other direction.
So Dr. Markowitz is polar opposite, and Mr. Dent seemed to consider academic data out of date, Nobel laureates out of touch.
I hate to say it, but that's kind of like having a discussion hundreds and hundreds of years ago trying to tell somebody the world's round when everybody thinks it's flat. People just discount it. They say, oh, demographics, that's too simple. Yes, people will say demographics, I can see it being a factor. Our research shows it's the factor because even innovation comes from new generations, and the innovations turn into technologies that are adopted by those new generations. So even technology and innovation and productivity come from these generation cycles. So we see it as the factor, and it's very hard to convince traditional economists of that.
Dr. Markowitz was born in 1927, well after the debate was settled about the world being flat, and his list of accomplishments and intellectual achievements on behalf of investors are not diminished by time. His academic response is, cycles, technology, and innovation are factored by world markets. but not with predictable, precise results.
We don't get rid of uncertainty. We don't predict the market. We just ask what combinations of asset classes or securities will give you a portfolio which has least volatility for a given expected return, but that won't eliminate its volatility.
As I interviewed Mr. Dent in October 2004, the Dow Jones Industrial Average was 9,757. It was his bullish prediction that in the upcoming years, as far as the market was concerned, the sky was the limit.
We are predicting that 2005 will be another strong year for the markets. If by the second half of 2005, we don't see a strong market advance, in fact, if we don't see the Dow approaching or at new highs, we're going to question and say, well, gosh, have we missed something?
So in 2005, did the Dow Jones approach new highs? January 2005, it started at 10,729. And December 31st ended at 10,717. But Mr. Dent had this scenario covered too. He had hedged on his prediction.
In fact, if we don't see the Dow approaching or at new highs, we're going to question and say, well, gosh, have we missed something? Is there a bigger factor? Is this terrorism or geopolitical thing? Or is the valuation thing so strong on the other side that maybe we're overestimating?
But if the science of demographics missed in 2005, Mr. Dent is not detoured. His outlook is more aggressive for the years 2005 through 2009. His prediction?
Everything we have says 2005 to 2009 is going to be perhaps the strongest bull market in history, at least rivaling 95, 99, and perhaps rivaling 1925 to 29. We've got one scenario that says the Dow hits 32,000. I think the most likely is 35 to 40,000, closer to 40,000.
He said 35,000 to 40,000 by 2009. Dan Solon, securities fraud attorney.
All of the academic studies that show conclusively to any fair-minded, objective person that nobody has the ability to tell you where the market is headed. Nobody has successfully predicted the long-term trend of the market.
As you have witnessed, Mr. Dent did not correctly predict market direction either. He is highly educated, articulate, and he was wrong. He had predicted a market boom between the years 2005 through 2009 with a total cumulative return of nearly 225%. The reality, by May 1st, 2009, the Dow Jones had decreased by nearly 30%. Since 2005. His first response to this prognostication crisis was to change the subtitle of the book. The original subtitle is How to Profit from the Greatest Boom in History, 2005 through 2009. His next edition in 2006 has a new subtitle, How to Profit from the Greatest Boom in History, 2006 through 2010. He and his publisher call it an update, but it cast a fog over his interview with this program. During his 2004 interview, he had predicted 2010 was the beginning of a bust period. Bust meaning not working or out of order.
We're projecting a strong bust from 2010 to 2022. There are seasons to our economy, booms and busts, inflationary times, disinflationary times, deflationary times. Things we all show are driven by demographic trends and technology cycles. Again, like 82 to 2009, that's a growth boom season. 2010 to 2022, that's a deflationary downturn.
Boom through 2009. That didn't happen. His next prediction, bust, 2010 through 2022. Author and securities fraud attorney Solon says this ongoing ruse of market prediction is among the oldest tricks in the profession.
Now, given the fact that the markets can only go up or down, if I want to make a name for myself, I can go out on the line and issue a press release and I can say, well, I think the markets are going to go up by 40% in the next year. If that actually happens, I can issue another press release saying, obviously I have a unique insight on where the markets are going. If I'm wrong, then I just hope that nobody noticed.
I love that we live in the age of video, both on the internet and TV, because what it means is that we live in an age of accountability, where you can't in one day say something and turn around the next day and take it back and mislead people. These people should be called out and prosecuted for the charlatans that they really are.
Mr. Dent is being called out during this program. but he remains a darling in an industry that does not hold wrongful prediction accountable. It hypes right and it ignores wrong.
You've predicted all sorts of things that have happened in this country and other countries.
In 2009, with the gushing media enabling his act,
when everybody else told you were going to be wrong, you turned out being right.
Mr. Dent promoted another prediction with his book, The Great Depression Ahead.
All the demographic trends are down for years to come.
Take your money, you stuff it in your mattress, or you buy up a bunch of gold. You heard it from Harry Dent first.
The only thing more heinous than cashing in on somebody's fear is cashing in on both their fear and their greed. The Great Depression, of course, cashes in on fear about the future. At one point, the same author was writing books about the Great Boom, so he was cashing in onto the greed and the overexuberance of investors. So can you imagine being in a paradigm when you whipsaw investors from one angle to the other, greed and avarice and getting all you can, and fear and paralysis? This is the worst kind of fear-mongering.
Perhaps a Great Depression is ahead, perhaps not. But there's a proverb quoted in the book, The Art of the Long View.
He who predicts the future lies, even if he tells the truth.
I think there are three kinds of people who make predictions in the market. Those who don't know, those who don't know they don't know, and those who know darn well they don't know, but get big bucks for pretending to know.
In the early 21st century, the new stock-picking guru, best known or most notorious, is Jim Cramer.
Other people want to make friends. I just want to make money.
He is to the financial community what pro wrestling is to the sports world. Very loud and sophomorically entertaining.
They're all going to pay the Road Warriors way.
The fun guys in Lower Manhattan will never have a clue about.
He likes it.
Kurt, welcome to the show.
Mikey really, really likes it.
This stuff. You warned me. You warned me. Thank you.
But not very enlightening or educational. In its October 2006 issue, Kiplinger's magazine featured Mad Money, reporting a prominent previous qualification on the resume of the show's producer. She used to oversee the Jerry Springer Show.
And he's cheating on me with my foster sister.
Again, not considered a programming paragon of advanced study or erudition. Our job is to seduce, says Susan Krakauer, formerly of Springer, currently Mad Money producer and CNBC Vice President for Strategic Development. An amalgamation of Jerry Springer and pro wrestling has spawned Mad Money.
Shady issue. Personal foul.
Booyah!
Booyah, Karen.
And on this programming hybrid, Jim Cramer does it all. Takes your calls, picks stocks, yells out all kinds of advice.
So you make that change, and you make that change now.
On a powerful international television satellite platform, he distributes this advice every weekday night.
I think he's probably the antichrist of investing. I think he's probably doing more general harm to the investing public than any one individual that I can think of right now. He's confusing people between what prudent long-term investing is versus speculating and gambling. And definitely with the kind of rhetoric, the hype, the horror, just the very mania, just turn on the show or listen to the radio, just the very manic, out of control style of the show itself screams imprudence, speculating, gambling, and hype.
Fast forward to March 2009. Cramer ran into a challenge from a rival point of view he appeared to underestimate.
A comedian's attacking me. Wow. He runs a variety show.
Variety show? What? You make it sound like I'm some kind of buffoon. Just flapping my arms with crazy buttons and wacky sound effects. Exactly.
The network feud developed because Jon Stewart had the temerity to question Cramer on his stock picks, especially Cramer's advocacy for Bear Stearns picks videotaped just prior to its fire sale to J.P. Morgan in March 2008.
Although Jim Cramer did write an article for MainStreet.com complaining that we had unfairly used a video clip out of context to make it look like he recommended buying Bear Stearns stock a week before it collapsed. Well, we went back to the tape to listen.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine.
Oh. Okay. I was wrong. Actually, it's true. He wasn't saying to buy Bear Stearns. He was simply saying that if Bear was your broker or that your money was at Bear, your money would not disappear. He was not addressing the value of holding Bear stock. So, Jim Cramer, I apologize. That was out of context. Technically, you were correct. You weren't suggesting to buy Bear Stearns. That was something that you did 5 days earlier in your buy or sell segment.
I believe in the Bear franchise. You know what? At 69 bucks, I'm not giving up on the thing.
Yeah! Of course, while Cramer wasn't giving up on Bear at 69, 11 days later, the stock market was more comfortable with it at 2. He's not saying literally, I'm asking you to buy Bear Stearns. For that, you'd have to go back a full 7 weeks before the stock completely collapsed.
I'm asking people who are watching this video to buy Bear Stearns.
Now, that was 7 weeks before it collapsed. In the interest of context, continue.
I'm asking people who are watching this video to buy Bear Stearns. Now, Bear Stearns acts much better than it should. Now, that's just intuition. And I don't want to put too much faith in intuition, but I have had good intuition over 29 years in investing. And I just think that this one has a very big upside, very limited downside here. They're very good at cutting their losses at Bear, but Bear, I believe, is for sale, and I think there are many buyers.
Could be a bidding war.
Yes.
All right, Jim Cramer, you said it here. Wall Street Confidential. Buy Bear.
Cramer's next pick was also questionable. He accepted an invitation to appear on Stewart's show. Stewart sliced into the myths of Cramer and Mad Money.
What it feels like to us, and I'm speaking purely as a layman, it feels like we are capitalizing your adventure.
Okay. My first reaction is absolutely we could do better. Absolutely.
The question to ask yourself as an investor is this: is Cramer's show investment education or entertainment? The station he represents is not in the investment business. It's in the ratings business.
I'm a guy trying to do an entertainment show about business for people to watch.
His job is not to educate you. It's to entertain you. And if along the way the picks of Mr. Cramer work, then fine. But CNBC has a disclaimer. All investors should read it. It's one of the longer disclaimers as disclaimers go. All opinions expressed by Jim Cramer on this show are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on radio, internet, or another medium. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. Cramer's statements and opinions are subject to change without notice. No part of Cramer's compensation from CNBC is related to the specific opinions he expresses. Past performance is not indicative of future results. Neither Cramer nor CNBC guarantees any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on the show. In the 21st century, your money concerns, your 401k, your IRA, or however you're providing your monetary future, have become investainment.
Investainment is the wrong way to invest. Investing on news, investing on tips, investing on what you see in television is just plain silly.
Most investors are headline investors, meaning they'll read the top line of what's going on and try to make investment decisions that way. Quite frankly, it's actually better if you are blind than to follow the headline.
With CNBC, with Bloomberg, with expanded financial coverage in the TV, with the internet, which let people check instantly on their monitors what the prices of all the stocks were. They could buy and sell in a split second. I mean, this added to the excitement. It's almost like an online casino. You get hooked on it. The adrenaline is flowing.
I think there's a real risk when we make, as though it were a sports event, the savings of individuals, their life savings and their retirement security, an entertaining activity. I think we're misleading folks, and it would be better if we didn't do it that way.
The bottom line is if it makes the cover of Money Magazine or Forbes or Barron's 99.99% of the time, it's something you shouldn't be doing. Because it's only the sexy and the avarice and the greedy and the fearful articles that catch human attention that make the covers.
If you keep in mind that the only time that fund makes the headlines is after it has performed, then it becomes very clear that's not the right time to buy it. So again, it is not intuitive for most investors.
What you now get on television is very glib, well-dressed people who have very clever ways of presenting information.
They got a dead cat bounce, baby, and I would be out of that thing.
But what's missing is there's absolutely no support for what they're saying.
Long and strong, baby.
They're all entertainers.
They make more money, upside surprise.
Okay.
And they can be very entertaining. But the problem is that people actually rely on what they're saying. Some of them are conflicted and have positions in what they are talking about. That's usually disclosed. But the underlying point that's really critical for investors to understand is all of this is an enormous waste of time.
The idea that you're going to get ahead of the curve, that you're going to hear something on CNBC or Bloomberg or any of the others that's going to put you ahead of the crowd is in fact very dangerous, because once it's out there, believe me, to the extent that there's real information, it's already reflected in the market price.
Think about the magazines that say 10 mutual funds to own now, or the 10 best mutual funds. You know, they're trying to sell magazines. Think about the good newspapers who list, here are the top 5 performing managers for the last quarter or the last year. So what? What does that prove? And the fact of the matter is it proves nothing.
You know, at least the brokers, there's the SEC and the NASD, you know, making an attempt to bring some honesty and ethics to this business. But the media, nobody holds them accountable. And it's hardly journalism when you start picking stocks for people.
Mr. Kramer did not return emails or repeated telephone calls requesting an interview for this program.
There are lots of interesting things to do in life, and one of them is not throwing your money away on what you read about in the paper or see on television.
The third scheme of investing is based on past performance. A firm advertises how successful one of its funds has been in the recent past.
The other myth is that there's some way of picking managers in advance or picking managers for the future based on what they've done in the past. There is absolutely no evidence that performance persists over the long term.
Here's an example of track record enticement. This full-page ad ran in the November 2000 issue of Money Magazine. Tech stock's still hot, and it displays a #1 ranking and 5 stars. Why? Because in 1998, the fund returned 196%, and in 1999, it returned 216%. Interested? Of course. So in 2000, this is the product to advertise. However, if you responded to this advertisement, added it to your portfolio, it did a negative 51% in 2000. Fogg researchers could not find any full-page ads for it in 2001. Maybe we missed it. Or maybe the new numbers didn't make it an attractive advertisement.
For individual investors, you've got to keep the long-term focus.
Jeremy J. Siegel is professor of finance at the Wharton School, University of Pennsylvania. He is a market historian and best-selling author of Stocks for the Long Run.
Do not be impacted and influenced by psychology at the time.
The average professional investor, the guys who run mutual funds, they are turning over every stock on average every year. They're getting in and out, in and out, in and out, and what they're doing is they're all following each other in hordes and in flocks. They're not evaluating rationally. They're running with the crowd.
Try not to follow the herd. That's so important when you're making decisions.
When pitching past performance as acceptable advice to the investing public, every commercial, print or electronic, and every prospectus is required to run disclosure with language similar to this. Past performance does not guarantee future results.
The real disclaimer should be, Actual manager performance has zero correlation with what they're going to do in the future. And then that should be right on the very front of the prospectus so every single person can see it. Of course, it's not.
What people confuse in the investment community is luck with skill. All of these guesses are no better than a monkey throwing a dart at a board. The markets are random and efficient.
Fog law number 1 in 3 parts. Disregard the big 3 schemes or myths. Do not market time, stock pick, or track record invest based on a manager's past performance.
Don't pick stocks. Don't pick styles. Don't pick managers. Eliminate stock risk and style risk and manager risk.
Your broker does not know what stocks are going to go up. Your broker does not know what the market's going to do next week.
Fog law number 2. Hire a financial coach.
What a coach does separate from, let's say, a stockbroker or a financial planner or someone that would recommend product or try to tell you when to buy and sell stocks, a coach is going to help you focus on the questions that are going to give you peace of mind. For example, how do you come up with an academic or scientific number to actually measure the volatility in the portfolio? How do you measure expected return in a portfolio? How do you measure total cost in the portfolio? A coach will actually help answer those very important questions and help each individual investor discover that for themselves so that they can truly have peace of mind.
All of us have experienced the help of a coach at some time in our lives. Perhaps it was an athletic coach, maybe the music director, the director of the school play, or an excellent teacher. In our lifetime, a coach has positively impacted a segment of our life and made it more fulfilling. The same is true of a financial coach. We are there to coach our clients to prudently pursue their financial goals. Being prepared for all situations is what coaches do for their teams, players, and students, and it's what we do for our clients.
Also pertaining to fog law number 2, a financial coach does not work on commission.
Commission-based brokers have a conflict of interest. They are paid only when there are purchases or sales. And very often the best judgment that can be made by an individual is to sit tight and neither buy nor sell. But a broker who's paid a commission lives by that commission, motivated by that commission. And whether it is perceived or actual, it still destroys the kind of integrity that should exist between a fiduciary advisor and the client.
So, are stockbrokers coaches? Dan Solon has been a securities fraud attorney for over 30 years.
Well, you need to send all your monthly statements to me.
He is the author of Does Your Broker Owe You Money? And he says brokers are not coaches, instructors, educators, or financial experts.
Brokers are basically trained to sell product, to generate commissions. They're not trained in basic principles of finance, and in fact the exams that they take don't really require any particular knowledge of finance. Brokers are simply salesmen, and investment products is what they sell.
We have a section in our book called Brokers Are Salespeople. I've been in my career through at least 2 training programs, and I will tell you that the industry spends the majority of its time in training brokers. It's about how to sell. The brokerage industry doesn't really want the broker to be a whole lot more than a salesman and an asset gatherer.
In an attempt to experience a stockbroker visit firsthand, Renee is undercover with a hidden camera visiting 4 nationally known brokerage firms. She is posing as a novice investor who will inherit $1 million. What will the broker approach be? An educational seminar on how to invest, or a sales pitch to win the commission on the $1 million?
I will tell you this, $1 million is not what it used to be. It's a nice number.
I don't like hearing this.
You know, relative to the market, we're going to be better.
And what I always say to brokers, when I cross-examine them, they're always telling me how they're watching the market. I always say, what are you watching for? What will your watching tell you? People believe if they study more and are really thorough about reading everything, that this is going to give them some insight in the market. But think about it. There are tens of thousands of people studying the market. The chance of anyone finding an inefficiency in the marketplace, given the global dissemination instantly of all kinds of information is essentially zero.
It's all about the relationships. That's it. That's what's important.
I think you're right.
And, you know, obviously, yes, you can have a great relationship with your advisor, but if they're losing you money, then you know what? Something's got to go.
We're about people and the relationships and managing the whole process.
You want to go with a big company and a good company, a company that's been around a long time. And there's a lot of them out there. If for any reason you have to relocate, you move to a different location, you want to make sure that, you know, you don't pick a local company that if you move away,
Makes sense, yeah.
then you know what, okay, now I'm
You're
back
not
to
at square one, yeah.
one.
People believe that if they use brokers, especially the big brand name brokers, that they are getting advice that's worth listening to. However, since we know that $7 trillion was lost in the internet bubble, it should cause all but the most blissfully ignorant people to understand that there's something inherently wrong here. How could all these smart people be giving all this bad advice?
People that are making the decisions on what stocks to buy, all they do all day long,
Right.
they're the smartest minds in the country.
They outperform the indexes and everything, so it's worthwhile to pay for the managers here because they bring something.
The biggest lie is that someone knows what the best stocks are in advance. That someone's going to be able to tell you and or if you just hire them to manage your portfolio, they'll be able to pick out the best stocks so that you can get all these huge rates of returns.
But there's absolutely no data supporting the fact that trading is good for clients. It tends to be bad for clients. Brokers add cost and subtract value. That's why people shouldn't use them.
You're the owner of the team. I'm the coach of the team.
We kind of view ourselves as like a quarterback. So we want you to come to us.
You're the team owner for the baseball team. I'm the general manager. Here's the baseball players that are going to go bat.
Gotcha.
Brokerage firms that spend $700 million a year convincing people that they have an expertise that's worth listening to, that people should trust them and people should rely on them. What I'm saying is there's no data supporting this, and people should neither trust them nor rely on them nor use them. They should avoid them altogether.
We have more products and services at your disposal than anybody.
I will tell you this right now, we are cheaper than every other firm out there. So again, we beat all the other firms out there that you're talking to.
That's very interesting.
Well, when you take a look here, the fees and commissions, the lowest. Stock returns, the highest, we get you the highest returns. The conduct, we're the second highest firm out there.
What would be good for investors would be if brokers studied the enormous amount of research that tells us that asset allocation accounts for 94% of the variability of returns. Therefore, brokers should be focused on asset allocation. Then they should focus on, once you get the asset allocation straight, now what do we invest in?
Keep in mind, too, whenever you hire a company, that company works for you, not the other way around.
The scariest thing about investing is there's two things, there's fear and greed.
Somebody runs way up, takes some of the money out of there and put it in the ones that are dogs, because the darlings become the dogs and the dogs then become the darlings.
If there was one person in these 700,000 brokers we have in this country who truly, really knew what was the best investment on any given day and the best time to buy and sell, he'd be so rich that Bill Gates would be working for him.
The first thing that you need to do is, as you're doing, is pick a company. You know, it's tough because everybody, you know, as soon as everybody finds out, they're going to be chasing you.
I know.
Fog law number 3. Analyze your portfolio. It will protect against a myriad of errors, including being sold by a broker to gamble on an interesting story about a hot cutting-edge company. For example, Global Crossing was founded in 1997. The company story? Due to the overwhelming demand for the internet, we expect explosive growth in traffic worldwide as we lay hundreds of thousands of miles of undersea fiber optic cable to connect countries and cities all over the world. This would enable the internet, where .coms were turning nobodies into billionaires overnight. Gold mine, so went the story. Global Crossing. Bankrupt, January 2002. Investor Fred Vigorito had heard a similar story about a can't-miss stock in the early 1970s.
The first purchase was basically because of a hot tip in the office. I mean, I was in the telephone business, and someone said that MCI was going to be a great company in the future. So a bunch of us in the office bought 100 shares of it, and then it grew from there.
In 1983, Mr. Vigorito met a man at a major wirehouse he perceived as much more than a mere broker.
Being a young fellow, not really that experienced in investing to begin with, and here my broker introduces me to a guy who's a vice president.
When you walk into a brokerage firm, if the person that is assigned to you doesn't have at least a title of a vice presidency, he's probably merely there just cleaning out the trash that day. You wouldn't believe the authorized titles they let the stockbrokers have these days. Everybody's a vice president. You can start at the firm, it's your first day on the job, and you'll be a vice president. They give people senior vice presidency, and these people are barely out of college. And then some of my favorites ones are senior vice president, international portfolio management. And this individual a year before was selling used cars. So don't be fooled by these titles. They are meaningless. It's one of the reasons that investors have a tendency to trust their brokers so much. If they called them maybe stockbrokers or called them salesmen, they might question their opinion. But when they assign somebody to your account and he's dressed very nicely and maybe he's got a nice college degree and they give him the title of Senior Portfolio International Management, you think this guy is a guru.
I thought this guy was a genius.
Mr. Vigorito stayed with his broker for 18 years. The portfolio pinnacle?
The total portfolio was about $2.3 million.
But Mr. Vigorito was concerned as early as the mid-90s about the mix of his portfolio.
I went to him and I said, I'm going to be retiring, I believe, in 1996. What should we do? And, you know, it was a lengthy meeting, but the gist of it was, what are we going to do with the WorldCom? And I told him that I was going to have to live on the money. Not completely, because my wife was still working, but I told him that I would be writing checks against it. And he said, don't worry about it. Let's leave it as is. And as a matter of fact, I have a little note from him that basically says that. As agreed, we're going to hold on to WorldCom.
WorldCom bought out MCI in 1998 and soon operated the world's largest internet network and the #2 long-distance telephone company. WorldCom was a hot tech stock at a hot tech time and a darling of Wall Street until it plunged into free fall.
And I watched the stock slide all from its high of, I think, $96 a share off the board eventually. And all along the way, he said to me, don't worry about it. He even said to me when it was at $5 a share, it's still a buy.
Mr. Vigorito's portfolio, once valued at $2.3 million, was positioned 99% in WorldCom stock. 99% in one stock under the aegis of a prosperous, nationally known brokerage house.
Even when it was getting to the point where it looked like it was going to go down into single numbers, they would say that all of the rumors about the company going under are false, and don't worry about it, it's going to come back. And he would tell me about how many billions of dollars in cash they had, and just continued to pump it up. Even when I called my first meeting, when I really got concerned with all of this, which was August 21 of 2001, and at that meeting, his manager, the first thing his manager said at that meeting was, why does this customer have so much WorldCom stock? And I was like, I couldn't believe, because I'm saying to myself, why doesn't this manager already know exactly how much stock I have? I mean, wouldn't he be involved here? You're talking about a retired person with 99% of his portfolio in one stock.
Mr. Vigorito tried to work a settlement with his brokerage house.
And I found that the manager didn't seem to really care about my personal problems. He seemed to be more interested in covering himself
The individuals at brokerage firms who are supervisors are charged with monitoring not only every broker under their supervision, but every single account that those brokers have. The problem is that those supervisors have many of the same conflicts of interest as the brokers themselves. So I'm not at all surprised to hear that when Fred brought his complaints to the manager, that the manager reacted defensively. Generally speaking, when accusations are made, there's a real circle the wagons mentality that happens.
Tracy Stoneman and Douglas Schultz represented Mr. Vigorito at arbitration. His case, a once prized $2.3 million portfolio reduced to $700,000 because of it holding 99% in one stock, a stock that bankrupt.
I would say that it's one of the more egregious because it was so black and white in many ways, a virtual 100% concentration in one single stock. And so that in and of itself made it probably more egregious than most.
Mr. Vigorito won a settlement, that is, if you call a win being awarded a fraction of the claim.
And I called Tracy, and Tracy was in tears. She couldn't believe what they had done, offering to pay $32,893, which is exactly what my out-of-pocket expenses were. And they awarding us zero for compensatory damages, and not even addressing mental anguish or anything punitive.
It is rare to meet a brokerage firm client who understands the conflict until they lose most of their portfolio. Then they start looking for what happened and why, and does this make any sense? That's when securities arbitration lawyers analyze portfolios. And that's when we say, did you realize that given the volatility of your portfolio, based on the historical data, you could lose 40 or 50% in any 1 year? And no client understands that.
It used to be hard to persuade people that they shouldn't go into everything into tech stocks. I remember, driving home and hearing the Motley Fools on the radio saying, if you diversify, that's going to slow you down, and if you if you go into anything except the tech stocks, that's going to slow you down. And people used to believe that, but since March of 2000 and thereafter, why. It's not hard to persuade people that they should be diversified.
Today, Mr. Vigorito, who had retired, is working again.
I'm a musician, and I'm playing every job that I could possibly get. I used to play with just one band, and now I've sort of put the word out there so that I'm playing military funerals. I'm doing school education programs, teaching kids how to play jazz. In some ways, I feel stupid because, that's what the average person looking at my portfolio would probably say. But then again, I say I'm not going to beat myself up because I'm not the one that was calling the shots.
WorldCom filed for bankruptcy in July 2002.
If Mr. Vigorito would have had his portfolio prudently analyzed, he would have known his portfolio was fatally overweighted in one stock. He would have known he was not diversified, he was not properly allocated, and that he was being misled into the portfolio killer of gambling and speculating with his money. Portfolio analyzing is an excellent method of educating the client as to what investing truly is. It also provides built-in warning signs so that the perils of what happened to Mr. Vigorito will not happen to any other unsuspecting investor.
Fog law number 3 of analyzing your portfolio will also safeguard being properly diversified and allocated, the two primary factors which account for nearly 100% of positive portfolio return.
Protecting against your own misunderstanding and ignorance is the least costly, most useful thing you can do to make sure that you don't get really hurt in your investing. So diversify would be rule number 1.
No analyst, broker, or human being can consistently predict the future to ensure future portfolio profit. Therefore, an investor must be diversified. In fact, if a person could consistently predict the future, that person would not be doing something as mundane as analyzing asset classes or individual stocks for a living. Since we know it's beyond human capacity to consistently predict the future, we diversify our portfolio. True diversification is not forecasting or adjusting a portfolio because we think we see a trend. Diversification begins with owning world markets and investing via valid, academic, Nobel Prize-winning research.
The idea of a random walk is that the stock market doesn't have a memory. Where it went last day, last hour, last week, last month, doesn't tell you anything about where it's going to go in the future.
When it comes to the stock market, if the market continues to work in the future as it has in the past, on the average you will make money. And there'll be uncertainty.
And uncertainty appeared in many forms by 2008. Bailouts for companies once considered invincible. Unemployment. Massive mortgage foreclosures. All became symbols of economic uncertainty in the first decade of the 21st century. The now famous irrational exuberance addressed by former Fed Chairman Alan Greenspan in 1996 had evolved into an era of uneasy apprehension. The market moved. It even dipped below 7,000 in March 2009, but it remained efficient, unemotional, and objective.
There's a difference between uncertainty and panic. Uncertainty can be managed through diversification and putting together a prudent portfolio. Panic, on the other hand, is always destructive. And what it causes investors to do is to put their head in the sand and be so paralyzed as to not be able to capture the rates of returns that are there for investors to achieve long term. So one of the greatest dangers to an investor is pure, unadulterated fear. And my underlying message to investors is this: that equities long-term are the greatest wealth creation tool known to mankind. And by studying history and watching how the markets recover, an investor can prudently diversify their portfolios. It only takes on average 111 days to recapture, historically since 1948, all of the rate of return that has lost in down markets and crashes. So when markets recover, they do so very fast and furious. And it's the investors that lost money, panicked, and never allocated back into the market prudently who are the long-term losers.
Portfolio analysis will also verify holding and owning the world markets while not hyperactively playing your portfolio like a Vegas gambler.
Gambling has nothing to do with investing, should have nothing to do with investing. I mean, I think the best example you can think of when you get the gambling analogy, and I happen to like this one, is it's the analogy of a casino. And you go into the casino, and all these bettors basically would break even if it wasn't for the house, if it wasn't for the croupiers.
A croupier is a person who deals the cards, reels in the dice, spins the roulette wheel. The croupier represents the house, collecting the chips and the money. This is Steve Wynn. Mr. Wynn is a Las Vegas magnate. He says his house, it's called Wynn Las Vegas, takes on average 20% on each dollar bet. That's 20 cents on every dollar bet to the house, no matter if the bettor wins or loses. The house just needs you to bet. Mr. Wynn says his house is not concerned or involved with the outcome. If an investor allows its portfolio to be hyperactively traded, the house of active traders, the broker version of the croupier, collects steep transaction fees no matter if the trade wins or loses. Mr. Lewis Harvey is president of the Boston-based company Dalbar. Its mission is to thoroughly and objectively examine the behaviors of investors and the retail financial industry. A study of the 20-year period from 1993 through 2012 revealed that while the S&P 500 index, which does not trade or bet, earned 8.21%, the average investor earned a mere 4.25% over the same 20-year period. Translated, the cost of turnover, trading, and transactions lost 48% of the potential 8.21% gain, or left on the table over $25,000 of a possible $48,400. Much of what was left on the table went to the house, commissions to the brokerage firms via its croupier brokers.
What we have found historically is that investors tend to do just the wrong thing at the wrong time, so that their actual returns, the money that they have in their pocket after they've done their investment, is usually dependent on whether they get in at the right time and out at the right time, because there's all this activity going on.
Paying the house and its representative croupiers at Vegas may be unavoidable, but you do not have to pay the hyperactive version that haunts your portfolio.
And that's what we have in Wall Street, the croupiers of the financial system. So all investors get the market return until the croupiers get their big rakes there on the table and scrape off their share. And then all investors lose to the market, like all investors, like all gamblers do, lose to the house. So, if you got to go into the casino to buy your stocks, my advice is just get out of the casino and never darken its doorway again. Buy and hold forever.
Fog law number 4, ask the right questions. For instance, why is market return the goal?
There is no way of beating the total market, because the total market is the market.
Dr. Charles Ellis has taught finance at both Harvard and Yale. He is the founder of Greenwich Associates and the best-selling author of Winning the Loser's Game.
So for you to win, I have to lose. And none of the bright, smart, well-educated, hard-working managers wants to lose. Certainly not for their clients. So they're all doing their very best. So they tend to cancel out minus the cost of playing the game.
We've got this cult of witchcraft really out there. When investing, it's remarkably easy to capture the market's returns and remarkably difficult to do any better.
There's nothing average about a market return. As a matter of fact, market return is really an A+ strategy. An objective company named Dalbar, located in Boston, studies investor behavior and maybe more to the point, investor misbehavior. Studies have revealed that investors' portfolios often underperform the S&P 500 or other market barometers because the investor is being persuaded to misbehave. Meaning, getting in and out of the market costs money, and it makes the retail financial machine billions of dollars. Being properly coached to capture market returns is an A+ strategy because it pays the investor. This starts with education and asking the right questions.
Another of the right questions, why do free markets work?
There's this basic idea of capitalism as proposed by Adam Smith. And what he said was, through supply and demand, the market sets a better price than any individual or any committee could ever set. Well, there was another gentleman, his name was Karl Marx. And he said, no, because people are greedy, supply and demand will not maximize the wealth. We need a committee or an individual to set the prices, therefore maximizing the wealth to a society. Well, we know what happens. The experiment is over. Communism doesn't work. I mean, it's clear. Socialism doesn't work. If you believe that free markets work, not that they're perfect, but that they work and that they're the best system to maximize wealth, then you also, too, must believe that in the stock market, which is the most efficient of markets, because prices and new information is absorbed instantaneously.
Free markets work because it is the only system in which billions and billions of pieces of information can be taken into account and filtered to reflect an accurate, fair price. There's no committee of flawed human opinion, only a faceless loop of information. 18th century Scottish economist and author Adam Smith called it the invisible hand, which generates a fair price for the market and its consumers. Nothing is perfect, but used properly, free markets can work effectively and efficiently.
Clarity from the investing fog comes from asking the right questions.
The largest risk factor in all of their investing is not in the stock market, it's not in the economy, and it's not in the companies. It's inside the individual person, himself or herself. As people, we do more harm to our investments by a long shot than any other force does harm to our investments. We get confident when stocks are up. We feel great when the stocks we own are way up. We get uncomfortable and scared when stocks go down. It's a shame, but that's the way we're organized. And I'm sure it did us a lot of good back in the days of the caveman when we needed to get scared quickly or to get out of trouble. But it doesn't work in investing. And that's the biggest source of real difficulty. We get excited and positive and buy more when stocks are high in price, and we get unhappy and angry or frustrated and sell when stocks are low in price. Benign neglect is a wonderful thing in investment management. And the ability to stay the course and not get shaken loose is a terrific talent.
My fondest hope would be that investors would understand that they should be focused on asset allocation, that they should not be involved in any actively managed funds, that they should ignore all advice about market timing and stock selection. Then we wouldn't have any more victims that we have today amongst the investing public.
No one could tell the future to be certain. No one can tell where stocks are going to be at any point in time. But what I found was remarkable is that over 200 years of unbelievable changes that our economy has undergone. We went from a 90% agricultural economy to an industrial, now a post-industrial economy. We have gone through tremendous sociological changes as well as economic changes. And yet the returns long run on the market have been between 6 and 7% per year after inflation. I feel comfortable looking ahead and saying if you're going to hold for the long run, 20 years, 30 years, people put it in their retirement, I feel comfortable with saying that's the return that you're going to get. I can't predict every incident along the way, all the good and bad things that are going to happen to the world. But I think those basic factors that drive returns, drive productivity in our market economy, in our capitalist economy, those basic factors I think are going to persist in the future. And therefore, I do predict that equities are still going to do very well for long-term investors, even though I can't predict exactly what events are going to occur in the future.
And it's really a journey into self, not just what my pie chart looks like in my portfolio. And money can teach us a great deal about ourselves, but it starts with self-knowledge. To navigate the fog of investing is first to know yourself, and then to look on the outside about what strategies are best to function and build a portfolio. When I was a child in Charleston, West Virginia, I always looked up to and admired my father. He came from the hills and hollers of Charleston, West Virginia, lived by the railroad tracks in destitute poverty. And somehow, amazingly, he had lifted himself out of that situation and built a successful career and financial security for his family. One day I asked him, I said, how did you accomplish that? And the answer to me was quite interesting. He told me that the solution was by knowing the right questions to ask. He told me that as a child, if he had asked himself a question like, why me? Why am I destined to be poor? Why am I destined to be in poverty? Why am I so unlucky? His life would have turned out one way. Instead, the question he asked himself was, how can I make the most of myself? How can I use my skills and use the things that I'm great at to help other people? And I know that other people have created wealth and success in their life. How can I do the same thing? And so the questions are extremely important. And even today, I tell my kids when they go to school, make sure you ask a good question today. So what are the questions you should be asking yourself to ensure that you have a successful investing experience and that you can have peace of mind about your money and about your future wealth? We have developed, from years of experience, over 20 years of working individually with investors, and that means thousands and thousands of people that we've worked with, we've developed the 20 must-answer questions for you to truly have peace of mind about your money. And it will cut through and clarify what's truly important. So what we're going to do is we're going to play a game. What you're going to find is we've given you all flashlights. And what I want you to do is I want you to turn on your flashlight now. Everyone will have one. And the other thing you have is the 20 must-answer questions. And we're going to go through those 20 must-answer questions one at a time, and we're going to find out exactly where you are relative to getting true peace of mind around your money. Ready? Let's get started. Now, as we look at these questions and ask them individually, I want you to be rigorously honest with the answer, meaning that it has to be a 100% yes to be able to get a yes on the quiz. So the first question is, have you discovered your true purpose for money, that which is more important than money itself? I think everyone knows that money is not the most important thing, and people will even say money won't buy you happiness. But what we're asking here is, what is that one single thing to you that is the most important thing, and can you state it simply in one sentence? If you can, give yourself a yes. If you're a little bit shaky on this one, go ahead and mark a no. Question number 2, are you invested in the market? This is a real simple one, meaning do you own stocks or do you own mutual funds that are invested in stocks? These are called equities. If you are, then go ahead and give yourself a yes for this question. Question number 3, do you know how the market works? This is a little bit more complex, meaning if you have money in the market, where do the returns actually come from, and where are the risk premiums that add return to your portfolio? If you don't know this exactly, go ahead and take a no for this one. Question number 4, have you defined your investment philosophy? Most people know it's important to have a philosophy when it comes to religion or education or even business. But few people indeed have actually identified or even know that it's possible to have an investment philosophy. If you don't have a specific investment philosophy, take a no for this question. Question number 5, have you identified your risk tolerance? Meaning, have you identified the specific amount of loss in your portfolio or the specific amount of volatility that you can accept under any period of time, or are you kind of fuzzy about risk? Question number 6, do you know how to measure diversification in your portfolio? Now, everyone will admit that diversification is important, and that's pretty much common knowledge. But how exactly do you measure diversification, and what are the scientific determinants of how similar or dissimilar investments in your portfolio react to each other? If you don't know that scientific number or equation, have to take a no for this one. Question number 7, do you consistently and predictably achieve market returns? Most investors and even financial professionals don't know what the market returns are for various markets. So if you don't know what they are, you're going to have to take a no for this one. Question number 8, have you measured the total amount of commissions and costs in your portfolio? There are many internal and hidden costs when it comes to investing, and many investors, even believing they have no-load mutual funds, are surprised to find that when the stocks inside of their mutual funds are traded, there are huge costs inside of their mutual funds that they never even knew existed. So if you haven't had an independent cost analysis performed, this will be a no. Question number 9, do you know where you fall on the Markowitz efficient frontier? This is a very scientific term. Harry Markowitz won the Nobel Prize for investing when he determined a methodology for determining inside of a portfolio what is the amount of risk and volatility and what is the expected amount of return. And the idea here is to get the highest expected return for any given level of risk. Every investor's portfolio can actually be graphed and analyzed as to how much expected risk and return it has. If you've had this analysis done by your financial coach, you'll be able to get a yes. If not, it'll be a no. Question number 10 is tricky. When it comes to building your portfolio, do you know exactly what you're doing at all times and why? You know, most of us build our portfolio somewhat like we're walking through the grocery store. This looks good, that looks good. We're kind of going through life picking a CD one year, a mutual fund one year, and no one has actually sat down and determined how that mix of assets actually relates to each other. So instead of looking at the portfolio in total and then having a long-term plan to manage in up and down markets, it's more of kind of a hit or miss as we go through time. Typically, the only way to be able to get a yes for this is to work hand in hand with an investing coach. If not, you'll probably get a no. Number 11, are you working with a financial coach versus a financial planner? You know, a financial coach solves all the traditional problems that a financial planner actually creates. So if you've gotten 100% on the quiz so far, you're working with a coach. If not, you're working with the planner. If you are working with your coach and you haven't been able to get a 10 on all these, it's time for a little checkup. Number 12, do you have a customized lifelong game plan that guides all of your spending and investing decisions? You know, most financial planning processes end up with very vague and nondescript goals like retire at age 65 with $100,000 of income. That's not nearly enough to define what's important for you. What do you want to accomplish in your life? Who do you want to help? What adventures do you want to have? What's truly important to you? These are the questions that a lifelong game plan will address, and then tie that specifically into how you should invest and grow your money for your future. 13, do you have an investment policy statement? This is a roadmap put down in writing that identifies the specific amount of risk, the specific amount of volatility to your portfolio, and clearly delineates what we're going to do in up and down markets and how to weather the storm of changing economic and global conditions. Number 14, have you identified a clear-cut strategy for measuring the success or failure of your portfolio, meaning that once you put your portfolio together, how do you know that it's doing exactly what it's supposed to do, and how do you monitor that on a year-to-year basis? If you don't have a clear vision of that and know specifically how to measure it, it's a no, and if you do, you get a yes. Number 15, do you fully understand the implications and the applications of diversification in your portfolio? Most people view diversification of just having a bunch of stuff. In reality, it's much more complicated than that. So, do you really fully understand why specific assets are in your portfolio and what they do to the overall risk and return scenario? Number 16, do you have a system for measuring volatility in the portfolio? Now, every financial planner on the planet will say it's important to measure risk, but in fact, they give you nothing to go on. There is actually a scientific and academic methodology for measuring risk, and you need to know that number to have peace of mind. If you know it, you can give yourself a yes. If not, we'll have to take a no. Number 17, are you aware of all of the incentives that brokerage firms and the financial community have in selling commission-based products? It's sad to say but true, but hidden deep within the voluminous prospectuses of many investments are all the conflicts of interest and additional ways that brokerage firms and the financial community get paid that very few investors are aware of. Number 18, do you know the 3 warning signs that you are speculating and gambling with your money? It's easy to get led astray when the media, the financial community, the news programs, and the books all are touting speculating versus prudent investing. It's essential to know when you're tempted to speculate and gambling exactly when that is and when you're actually prudently investing. So do you know when you're investing versus speculating, yes or no? Number 19, can you identify the cultural messages and personal mindsets that rob you of your peace of mind? Many of us have learned improper thinking when it comes to investing, money, and fear about our wealth and what it's supposed to do for us in the future. It's essential to be able to identify those personal beliefs that destroy your peace of mind and the cultural messages that are consistently bombarding you to make imprudent decisions. Yes or no? Number 20. This is truly the only question you have to be able to answer a yes to grow. And it's very simple. Are you ready to shift your personal mindset from one of scarcity to abundance? Because we live in a world rife with misinformation, encouraging people to speculate and gamble with their money, and we live in a world of continual strife, wars, recessions, depressions, etc., most investors live a quiet desperation of not really knowing what they're doing and why they're doing it. Therefore, they live in a scarcity mentality that terrible things might happen to them or their portfolio and destroy their ability to live life powerfully and with passion. There's perhaps nothing more important than the growth of your financial resources to ensure your future. So if you're ready to move from a mode of scarcity to abundance, meaning not enough to more than enough, that's the only real thing you have to be able to answer yes to make progress. So here's your great opportunity to move from a mode of scarcity to true abundance. So take out your opportunity card and hold it over your head with your left hand. Everybody follow along with me. Hold that opportunity card high up in the air. And then what I want you to do with your right hand is take your pen, assuming you're right-handed, and then write your name on the first line. Everybody do that with me right now. What I want you to do next is write your address on the next line and then write down your phone number, the easiest way to get a hold of you. Today that's usually a cell phone number. And then your email address, because we may be inviting you to future workshops and seminars. Then what I want you to do is do yourself a huge favor. I want you to take your pen and put it over the yes circle. Everybody do that with me now. Take your pen, put it over the yes circle, and what I want you to do is to check off that box. It's the most important thing for you to do tonight. So your financial coach is going to spend 45 minutes with you in a free consultation to help you explore and discover how to get more yes answers. They're going to help you look at what the risk is, what the volatility is, what the expected returns are, what the hidden costs are. They're going to be able to educate you in a way that no other financial planner or broker could ever even dream of. So the most important thing for you tonight is to ask those right questions and find the answer. And what your coach will do with you is work hand in hand with you, step by step, to find those. Many of you are here tonight as a guest. You've been brought by someone that works hand in hand with your financial coach. They're here for a reason, and they opened up an opportunity for you to look and explore to see if this can help you and put you in a better situation. I'd like you to thank them for inviting you here tonight, and I know they're taking a powerful stand that you can have true peace of mind around your investing. We hope you've had a great time tonight. We hope you've learned a lot of information. We hope you'll move to the next step and explore the answers to those 20 must-answer questions. We know everyone in this theater can have true peace of mind if they just take the next step. As you file out and walk down the aisles, we'll have 2 assistants on each side taking your card from you We want to thank you for being here tonight. We're excited about your future. We want you to have true peace of mind. I'm Mark Matson. Thank you for being here.